Unlock the secrets to smart real estate investing in the Texas housing market.
Absolutely. Today we have insights from experts like Jason Walter and Cathie Wood who are here to guide you.
They'll reveal the trends and strategies you need to know to navigate these market changes.
And remember, we've condensed hours of financial insight into just minutes to save you time and enhance your understanding.
Imagine uncovering investment opportunities before they become mainstream.
But first, a quick disclaimer. This content is for educational purposes and not investment advice.
Stay tuned. After these insights, we'll tackle an eye-opening discussion on the real estate debt crisis.
You don't want to miss it.
Ken McElroy sounds the alarm. There's a silent bomb in the real estate market that investors must heed.
Absolutely. He argues that the commercial real estate sector is facing its own debt maturity crisis, drastically different from the residential market.
Right. It's like a ticking clock, and it's been building for years. Can we really afford to ignore that?
McElroy emphasizes that investors must grasp what the debt maturity wall means for their portfolios.
What's really at stake there? It sounds like something investors can't afford to ignore.
It's definitely pivotal. Think of it as a deck of cards. Remove one, and the entire structure could collapse.
Ken breaks down the capital stack, which is crucial for understanding how deals are financed.
Wow, so these layers really show how interconnected real estate financing is, especially with debt.
Absolutely. You could say it's like a three-legged stool. If one leg is weak, the whole thing could topple. McElroy reveals that a staggering $640 billion in loans will mature within the next few years.
That sounds overwhelming. What does he say will happen to the market then?
It's a high-stakes game. If those properties are worth less than the loans, it is a recipe for disaster.
With McElroy's insights, the true scope of the commercial real estate downturn is coming to light.
It's like watching the tide go out. You can see what was once hidden beneath the surface.
Everything is moving against the habit of property values rising. How can that be mitigated?
It's critical for investors to reassess their strategies now, according to McElroy.
What should they be focused on doing differently?
It's essential to adapt to changing market conditions, almost like shifting in a dance. Not all moves will work in every song.
Ken forecasts that the next few years could bring unprecedented volatility to the real estate market.
What's motivating that prediction? Is it just the looming debt expirations?
Yes, and once people start defaulting, the ripple effects will hit bank balance sheets hard, leading to tighter lending practices.
He predicts a trend shift toward residential investing as the market stabilizes.
Interesting. Are residentials really projected to stand out even with housing affordability issues?
They are. It's like a sturdy tree with deep roots, as opposed to a leaf drifting in the wind.
In a nutshell, ongoing vigilance and adaptability might be key to weathering this storm.
Exactly. If you're navigating this sea of change, knowledge truly is your compass.
So you're telling me to essentially be the captain of my own financial destiny. Count me in.
As major companies announce mass layoffs, we need to consider how these job losses will impact the housing market. How do you see this playing out?
Absolutely. With mass layoffs on the rise, home prices could collapse as many employees with mortgages are directly affected.
Will laid-off workers panic sell their homes, driving prices even lower? That sounds serious.
I draw parallels to the 2008 housing market crash, where job losses flooded the market with foreclosures.
It's alarming. If people can't pay their mortgages due to layoffs, we could see an influx of homes on the market.
Could this lead to a market panic? What kind of data backs this up?
Job losses don't exist in isolation. As I mentioned, they have a ripple effect on various industries.
Exactly. Just like a stone thrown in a pond creates ripples, losing jobs in one sector can affect jobs in multiple others.
What's the scale of that ripple? How many jobs are at risk?
Wells Fargo recently announced laying off 721 employees. That number alone can significantly shift housing stability in the area.
What's fascinating is the area's home prices soared by 35% prior. Will these layoffs set us up for a correction?
That seems drastic. Is there a chance people in those regions can bounce back quickly?
As the housing market faces chaos, it's critical to look at industries poised for growth, like cybersecurity and renewable energy.
It's like a financial garden. When some plants struggle, others can thrive.
So if I were in the job market, I'd need to shift focus to these burgeoning fields.
If these trends continue, what's your prediction for home prices in the next year?
We could see significant volatility. Home prices might drop sharply if laid-off workers flood the market.
That sounds like a perfect storm. How can someone prepare for that?
While home prices could drop, demand for rentals may surge as many individuals look for affordable housing solutions.
Fascinating. It's almost like a pivot in the housing market dynamic.
So for investors, buying rental properties could be a smart move, right?
Adaptability will be the key skill in navigating this next economic chapter.
Exactly. It's about staying nimble and ready to respond to market changes.
Sounds like my mantra for life. Always be prepared.
It's fascinating to see how the housing market is shifting right now. Just last week, Jason Walter unearthed some enthralling insights.
Absolutely. He pointed out that asking prices have actually seen a small increase for the first time since May this year.
What's causing that? Isn't inventory still quite high?
Exactly. More homes for sale generally leads to lower prices, but Jason explains why that trend seems to be reversing.
He notes that despite the high inventory levels, the competition has shifted as asking prices have risen.
How can that be? Isn't it typical for prices to drop when there's more supply?
That's a great question. It's all about the nuances of demand versus supply, which Jason breaks down nicely.
Jason highlighted that while inventory continues to rise, the shortage of new listings puts pressure on prices.
So could it be that buyers might have a bit more negotiating power?
Exactly. He suggests that with more homes available, buyers could negotiate better deals.
He observes a notable uptick in pending home sales, which jumped nearly 15% from October to November.
More pending sales, but slower selling times. I'm confused how that works.
It's essentially a sign of market recovery and increased interest from buyers, albeit with some delays.
Jason provides actionable advice. He believes buyers should target offers below asking prices when inventory is high.
And checking for builders with fiscal year ends could yield significant discounts.
Exactly. He emphasizes that strategic timing can be beneficial. Jason predicts that home price growth could decelerate due to increased inventory and other factors.
Can we chalk this up to affordability gaps too?
Absolutely. Higher prices versus stagnant wages means buyers may hold back.
He notes a concerning trend. Certain states are seeing an increase in inventory compared to 2019.
And why is that significant?
It suggests regional discrepancies in the market's recovery post-COVID.
In sum, he emphasizes flexibility in strategies is crucial for navigating these changes.
That's hopeful yet practical advice, especially for first-time buyers.
Exactly. It's all about adapting to the current landscape. Today, we're cracking the code on effective real estate investment with the insightful Henry Washington. Are you ready to unlock this potential?
Absolutely, we're responding to real questions from the BiggerPockets community and sharing practical answers.
I can't wait for these insights, especially on seller financing and the BRRRR method. Let's do it.
Look, the beauty of seller financing is that it can be a win-win if both parties really understand their goals.
That's fascinating. What are some scenarios where seller financing shines?
But what if the seller is desperate for cash? Doesn't that complicate things?
In scenarios where sellers own properties outright, they can really benefit from seller financing.
So sellers can structure terms to minimize tax burdens as well. Amazing.
It sounds like a financial puzzle where both sides need to align the pieces carefully.
What do you think about focusing entirely on one-bedroom apartments?
I think that's a smart move. They're often recession-proof in tough markets.
Interesting. So they're like the reliable workhorses of rental properties.
Henry, you mentioned the advantages of treating your primary residence as an investment.
Exactly. Using the equity you build can fuel future investments.
So it's like flipping your own space while enjoying the benefits.
Henry, where do you see wholesalers fitting in as the market evolves?
If wholesalers can master ethical practices, they'll thrive while serving investor needs efficiently.
It's like a double-edged sword. Great potential, but risky if mishandled.
To succeed, you really need to be strategic and adaptable.
It's like cultivating a garden, nurturing those sales while keeping weeds at bay.
An investment's potential is only as good as the strategy behind it.
Hurricane Helene left catastrophic damage, but are the local authorities doing enough to address the aftermath? We're here with Melody, who has some critical insights.
Travis, it's shocking to see that almost 9 weeks later, the devastation in Erwin is still so pronounced. The debris piles are nearly untouched.
I feel like I'm witnessing a cover-up here, especially after seeing those radioactive markers on the containers.
The implications of ignoring these hazardous materials are serious. Don't the authorities realize those piles could be poisoning the water source?
Absolutely. What about the workers on site? Melody, aren't they at significant risk?
They are. It's baffling to me how they're working without proper masks. It's a potential disaster waiting to happen.
It's alarming to witness workers in such toxic environments without respirators, right?
Exactly. This isn't just a minor oversight, it's their health on the line, amidst what looks like nuclear waste.
So ensuring safety equipment isn't merely protocol, it's crucial for survival.
If precautions aren't taken soon, this could escalate into a full-blown environmental disaster.
That sounds worrisome. Is there a timeline for local authorities to address this?
So far, there seems to be no urgency from government levels, which is alarming.
The situation is an outcry for transparency and responsibility. We're at a critical juncture.
Exactly. It's essential for the local community to band together and demand action.
It's about their lives. Weathering the storm is one thing, but living with its consequences is another.
What an enlightening discussion we've just had.
Indeed, all 5 guests brought unique perspectives to the table.
Melody's insights into the aftermath of Hurricane Helene were truly eye-opening.
Absolutely, and combined with Henry's tips on seller financing, it offers a fresh approach to investing.
Then there's Sachs, drawing stark warnings from history about the current job market.
Right, and let's not forget Ken's take on the looming debt crisis, which is quite alarming.
It's intriguing how they all agreed on the need to adapt investment strategies.
Yet they diverge so much on the timing and severity of the impacts. Makes you think about how complex this landscape is.
It really does add layers to our understanding. If you loved what you learned today, don't forget to hit that like button.
And subscribing is a great way to stay updated on these important insights.
Thanks for joining us. Be sure to check out our other videos for more on the financial world.